Hello, this is Brent Gregory with an explanation of posting items from a special journal to the General Ledger and posting items from a special journal to a subsidiary ledger. Now I'm just going to work with the sales journal, and this is not about how you put together a special journal. See the videos on that. So let's do a bit of setup, because I did do a bit of preparation earlier, but basically I'm just going to take this as it comes. So we'll look at the special journals, the subsidiary ledger, and the subsidiary ledger here we'll look at the Accounts Receivable Subsidary Ledger, and we'll look at a subgroup of the General Ledger. So let's have a look firstly with the General Ledger. I've just put in 4 accounts that we're going to work with. Accounts Receivable, that's people that owe you money. Inventory, sometimes also called merchandise inventory, that's what you have to sell. Your sales, and your cost of goods sold. Now 2 of these items have opening balances. That is the inventory, so there's $2,000 worth of stock in your storeroom or on your shelves or wherever. And accounts receivable, June the 1st, there's an opening balance of $1,000. That means someone or some number of people owe you $1,000. And how will we find out what the breakup of that is? Well, we go to the subsidiary ledger, accounts receivable, and we see we've got 3 accounts, Bill, Bob and Brent, and Bill owes us $1,000. Bob nor Brent have no opening balance. So let's go back and we'll just run through 3 transactions. So the date, let's say the 1st of June, 1, account credited Brent, account debited, we're going to sell Brent something, invoice number might be number, I'll make it 1. Reference, that is the posting reference, which we haven't done yet. That's actually, this is the posting reference to the subsidiary ledger. Sales, let's say $200. So, and that's a debit to accounts receivable, credit to sales, and we also need to bring to account our cost of goods sold. So let's say our gross profit margin is 40%, therefore our cost of goods sold will be 60%. So 60% of 200 is $120. Now next, let's go June 2, and we'll sell Bob, invoice number 2, $1,000. $1,000, 60% of that is $600 is our cost of goods sold. Now the next day, June 3, we make a sale to Bill. We'll call that invoice number 3. We'll make it $800. 60% of 800 is $480, and that's our sales in the sales journal. So we've made these credit sales, all credit sales, and we're now ready to post them. Let's say this is now the end of the month, that's all we've done, so we now need to total these. So 200 plus 1,000 plus 800 is $2,000. So we now need to post that to accounts receivable and sales, $2,000. So we go to the General Ledger, and we have accounts receivable will be a debit of $2,000, and that would be June 30. The explanation, sales for June, though we don't really need an explanation because the next bit will tell us S1. So S1 stands for Sales Journal 1. So that's to tell us this is the journal reference, this column, reference, journal reference. The journal is Sales Journal 1, debit to $2,000. We already were owed $1,000, so that's going to make our balance $3,000. Then the other side of that transaction was sales, so that's June 30, and actually when we say sales here, this is the credit sales for June. This will be again credit sales, June, reference sales 1, and this is a credit of $2,000, and so we have a credit balance of $2,000. Now we posted those to accounts 103 and 401. So now we go back to the sales journal and we go 103, 401. So that tells us we've posted $2,000 to account 103 and to account 401. So now let's post the cost of goods sold in the inventory. So this adds up to $7,200, $1,200, sorry, $720, and 480 is $1,200, and as we'd expect, that is 60% of $2,000. So what are we going to post that to? Debit cost of goods sold, credit inventory. So back to the general ledger. Debit cost of goods sold, $1,200. So the date, June 30. COGS for June, COGS, that'll be, take it, June credit sales. We could make that a bit smaller, it won't all fit in. The reference again is S1. We've got $1,200 debit and our balance will be $1,200. Now the other side to that entry is going to be inventory. June 30, and it's our COGS for June credit sales. You could have any other number of explanations in there that work for you. The journal reference is S1, and this will be a debit of $1,200, and therefore our closing balance will come down to $800. We had a $2,000 debit, we add to that the $1,200 credit, so which is a reduction from it because this is a credit, so we've got $800 as our closing balance. Now again, let's take notice of the account numbers. 501 cost of goods sold, 120 inventory. So we're back to the special journal and we go 501 was cost of goods sold, 120 inventory, and that tells us that we've posted to account 501 and to account 120 $1,200. It tells us because the 501 comes first that account 501 is the debit, and it tells us because 120 comes second that 120 is the credit. Now that's part of our posting done. The next step is to make sure we post these items to the subsidiary ledger. So let's have a look. Brent, June 1st, $200. So subsidiary ledger, Brent, June 1, and we might put in here what we sold to Brent. Let's say fence posts. Reference is S1. It is a debit of $200, and therefore the balance is $200 debit as he had no opening balance. Then we go back to the special journal and we put a T in here to indicate that we've posted this to the subsidiary ledger. Once upon a time that would have been a tick. Now let's have a look at Bob. $1,000 on June the 2nd. Subsidiary ledger, Bob, June 2nd, and he might have bought lots of wire. Reference S1, the sales journal 1, $1,000, and the balance is $1,000 because there was no opening balance. Debit. And I guess you know the next step is to go back here and put in a T. Remember, once upon a time we would have put in a tick, but now we put in a T as a substitute. Now let's do the posting for bill. We go to the subsidiary ledger. Bill, June 3, and Bill might have bought, how much did Bill spend? $800. So debit $800, reference S1. He could have bought some fence posts as well. Fence posts. Now we have a balance of $1,800 of debit. Now we go back here and we put in a T to indicate that we've posted that to the subsidiary ledger. There's one more step, and this is where the concept of a control account comes in. So if we look at what the our total balances are, we see we've got $1,800 and $1,000 and $200. So when we add all of these up, they will come to $3,000. So the total of our Accounts Receivable Subsidiary Ledger is $3,000. We need to go to the General Ledger, to Accounts Receivable, and note that it is also $3,000. And this is called a control account. So the Accounts Receivable in the General Ledger is a control account to the Accounts Receivable Subsidiary Ledger. And that means it gives us control. So how does it do that? Well, it tells us what the total amount should be, and it tells us it should be $3,000, and we have that. So there is the quick idea of posting information from the special journals to the general ledger and to the subsidiary ledger. Again, if you want more information on the special journals generally, there's 2 videos on special journals. Have a look at least one of those. Bye.